Good weekend, all. Ira Epstein with your financial market wrap-up, and this wrap-up is with your weekly charts for Saturday, November 12th, 2022. I want to remind you, I've done another special report. Those of you on my mailing list know it, you've seen it. And I've done it on the dollar index this time, and it's trend and chart analysis in great detail. So we're going to cover the monthly charts. I break them down. Then I go into the weekly charts. I'll bring you into the daily, a little bit of everything. Seasonal patterns, the more research there, the price counts, and I'll talk about the fundamentals a bit with you as well. My reports only stay up on my website 3 business days because they're timely for right now. They're not meant to go back and look at later. They don't have relevance then. They're recorded now for right now. So if you want to see it, you're welcome to see it. All you need to do is take your cursor at the top of this video, move it across. You can hit it there. If you're looking on a phone and you don't have that, all you do is go to our website at iraepstein.com, go under research. It's right there. You can call my staff. They'll work with you and help you out, okay? I think you'll like what it says. I really cover a lot of detail. But what that does is it brings us to where we're at this week right now. So I want to start off with what did the market do? The argument is, and there's a big one taking place, the Fed pivot. It's going to happen, okay? What is a pivot becomes to me the first question, okay? If you consider that we're going to move from 75 basis point hikes down to 50 or 25s, and that's your idea of a pivot, I can't argue it, but that's not my definition of a pivot. My definition of a pivot is when we're no longer having interest rate hikes, because interest rate hikes that still string out continue to put pressure on the economy and can easily trip you into the recession. Don't forget that. There's a big difference. You know, I said this in my metal report. I'm going to say it here. You go to your doctor. You're ill. They're going to give you a prescription. It's rare that it's one pill, right? It's generally a series of pills that you're taking once, twice a day over some period of time. And sometimes you start off 2 a day, then you go to 1 a day, or you do like a Z-Pack, you take X amount at the beginning, 3, then 4, then 3, then 2, then 1. You understand what I'm saying? That's what I think we're in. So I think the Fed is now got to take the patient that's got an illness in it. Our economy is the patient. The illness is called inflation. And the Fed has been giving it dosage, and now the dosage is ready to change. It doesn't have to be 75 basis points unless the patient flares with a fever. What would that be? That would be the December reports coming in and showing that inflation went back up. So be it and or, the core goes up, the headline goes up, the jobs data goes up. Ideally, the patient gets all 3 slipping again. The patient's on the road to recovery. Should we go with and just drop the pills away? No, we're not going to do that because this thing can come back. So we'll go to 50 or 25 basis points. And that'll be the Dr. Powell, our Fed chair's decision based on the readings, I think, in December. I think I've given you the analysis, the best way that I know how, and I think it's right on the money as to where we're at. When I take a look at the S&P, any way you want to look at it on a monthly chart, you're still under the 18-month moving average. On the big picture, the trend is still down. When you go to the weekly chart of just closes, the resistance has been at 39.20. Okay, that's the 18-week average. We have more to talk about. But you closed over it, so the bias of the market shifted to the upside until you take out the prior break low. What was the prior break low? Well, we can find that. I didn't want to do it quite that way. Let me come back here. There we go. Here we go. I'm getting better at this. 37.04 and a quarter. That's what you'd have to take out right now in order to say, we're getting a flare-up again in the patient. Here's a weekly bar chart. The swing line is still down until you take out 41.58. So the overall pattern of lower highs, lower lows is still in place. The 18-week average, we just saw we're over it. So where's the next resistance? It's 41.88. I don't like that. That means you have to take out 41.58 to break the trend if I'm super bearish. So I'm nervous as a bear. I want to see the market not get that high. I want to, as a bear, have it drop right back below 39.20, 80 points from here this week. The bulls need to get it all the way up there and end the downtrend, or let it slip back and oscillate a bit, and then we play for the end of the year rally. Oh, I'm giving you the what I said in my report when I did it about 3-4 weeks ago. When we come to the Bollinger Bands, even if you clear the 100-week, you'd have to get to 43.2687. I think that's going to be very hard to do, very hard. When we take a look at the S&P 500 index with momentum, it's here. Now, I can tell you, if you go and you look at some of the main moving averages, I believe the 100-day, which you don't have enough days here to plot it, unfortunately, in a great way on the daily charts. Dailies, weeklies, you've got it. The dailies, it's around 4,100. That's what some analysts have been hanging the resistance on dailies. That's not the case on the weeklies. When we come to the Dow Jones, well, it's 30 stocks. The market is enamored with the old-time names. It's not in love with any of the tech stocks. Tell me tech stocks they're in love with. No, they're not there. This is no longer in a downtrend. That's important. And the NASDAQ is no longer in a downtrend. It's hard to believe. It's not in an uptrend. Neither of these are. You have higher lows, higher highs, but you're under the 18-week average. And the Russell is void of a trend. Lower low, lower high. So not one of the stock indices are in an uptrend, but they all have cases where they've stepped out of downtrends. Does that make sense? To a degree. To a degree. The S&P hasn't reached that point yet. Many of the others have. The NASDAQ, the S&P, and the Dow. When I go to the bond market, I have a pattern of higher lows, higher highs. The negative to this is that you're still embedded. When and if the red line closes over 21, you put into play that wherever the 18-week average is, that's where you're going. Right now, this is a bear market rally, but it's got good look to it, like maybe the pattern is over on the downside. Certainly, as a pure chartist without momentum, you've broken the lower highs, lower and low pattern. That's done until you reestablish and got through this week's low of 118.3. Plenty of reasons to not be short, but you need to lose the momentum to completely lose your bearish bias. The bias is still, in my opinion, down. The 10-year note the same, and you're probably going to lose that embedded reading on the opening Sunday night. Why? Because you're right at the highs of the week, and the way the math works on it, it's going to carry it through. If it stays lost, you're opening the door to the 18-week average getting up there. In the dollar index, I don't want to cover it. I've given you a special report. Go look at it. In the eurocurrency, higher lows, higher highs. What do you do the first time you hit a Bollinger Band? Up or down? Not embedded. Have you taken the enhanced Bollinger Band course? That's your answer. In the Canadian, we had signals to be out of shorts that this market was going to rally. What do I mean? Okay. So we come back here, 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 and here. This is where I want you to be. This is called embedded. You've got the market with the red and the blue staying under 20 more than a couple of weeks in a row. The market on this week gets a reading October 28th of 21.49. It's over 21. It puts into play that price and the 18-day average, because it's the closest main moving average, should make a run at each other before we get back through that low. It's saying don't be short anymore in plain English. Let me come back to that. I hit the wrong button. That's me. Here you are the week after. This is November 4th. Look what you did. Look what you did. Like the Go-Low ad. Look at me. Look at how I look. The Japanese yen, as you can see, same thing, sort of slipping back right here. You're over this number. You're no longer bearish. You lost your embedded reading. Okay, Bitcoin, higher high, lower low, lost the reading there as well. The differential between Brent and crude, just hanging at the 18-week average. But when you look at all the energies, they're trying to be bullish. Now we have another OPEC meeting coming up. They've got to be looking at the world economies. They have to be looking at how weak China has gotten. I don't care that suddenly China's gradually loosening up some of the policies on zero tolerance. Look at the problems, look at the lockdowns, look at the amount of cases. So could we be getting further production cuts? You're not going to put more oil out on the market from OPEC, that I can tell you. The question is, are they going to do more cuts? So the market's got a bullish bias here until it takes out this low. WTI, same thing until you take out that low. Upper Bollinger Band could be where you're headed. Gasoline, if you start taking out right here, the 250.93 level, you can actually fall down into this area. This market needs to not get through that and get back over the 18-week average of closes, and that would give it a bullish bias. So you put it all together, you have an interesting time in this market, one that I'm looking at super hard, trying to figure out what does it want to do from there. Well, I've given you what I think is part of it, and that is the special report on the currencies. Again, just go up here, give it a click, take a look. I'm Ira. I'll see you Monday.